Got it. Fine. Uh, in the beginning, fundamental analysis. Who remembers when fundamental analysis was considered the only real or proper way to make trading decisions? When I started trading in the 1978, technical analysis was used by only a handful of traders who were considered by the rest of the market community to be the very least crazy. So, as difficult as it is to believe now, it was not very long ago when Wall Street and most of the major funds and financial institutions thought that technical analysis was some form of mystical focus. Now, of course, just the opposite is true. Almost all experienced traders use some form of technical analysis to help them formulate their trading strategies. Except for some small isolated pockets in the academic community, the purely fundamental analysis is virtually extinct. What caused this dramatic shift in perspective? So basically, the author is telling that before during 1978, we are in 2023. There was only fundamental analysis. Basically, they go through the books, they go through the balance sheet and all these things, and then they have some ratios, and based on that they will analyze. So in 1978, a very few people were doing actually technical analysis, whatever we are doing right now. So but now it is completely opposite. Nobody, if you don't do technical analysis, it's like you're not in the trend, right? So he's now asking what caused this shift, basically the perspective, right? So in 1978, it was supposed to be some mystical focus, but now it is the norm. I'm sure it is no surprise to anyone that the answer to this question is very simple: money, right? So the problem with making trading decisions from a strictly fundamental perspective is the inherent difficulty of making money consistently using this approach. For those who may not be familiar with fundamental analysis, let me explain. Fundamental analysis attempts to take into consideration all the variables that could affect the relative balance or imbalance between the
भाई जितने जल्दी किधर
yeah. Okay. So basically, takes into consideration all the variables that could affect the relative balance or imbalance between the supply of and the possible demand for any particular stock, commodity, or financial instrument. Using primarily mathematical models that weigh the significance of a variety of factors, basically the interest rate and the balance sheet, weather patterns, and numerous others, the analyst projects what the price should be at some point in the future. So we all know that everything is basically, it is the difference between the supply and demand. So anywhere the chart goes up, it is basically a lot of supply zone, and if it goes down, it is a demand zone. So that is in the technical analysis. But here, what they do is basically they take factors like the bank interest rates, and they see the balance sheets of the company, weather patterns. That is basically for the commodities. So if there are any, some issues or something, rainy season and all these things, the commodity will become, it will go into a supply and demand zone. So those things and other things, an analyst will actually tell this price will be some point in the future because something is going to happen in all these factors. The problem with these models is that they rarely, if ever, factor in other traders as variables. So basically, supply demand means we have so many people, we are buying and selling, right? So I think what he's trying to tell is that that factor of what everybody is thinking, that is being discounted here. So people expressing their beliefs and expectations about the future make prices move, not the models. So basically, it can be rainy or sunny day, but if nobody wants to buy that particular commodity, I think it will not have any demand. That is so their beliefs and expectations, they actually make the prices move and not the models. The fact that a model makes a logical and reasonable projection based on all the relevant variables is not of much value if the traders who are responsible for most of the trading volume are not aware of the model or don't believe in it, right? So we don't, trade based on fundamental analysis because we don't believe too much in it, right? So as a matter of fact, so what is the point then in going through all this fundamental analysis? So as a matter of fact, many traders, especially those on the floors of the future exchanges who have the ability to move prices very dramatically in one direction or the other, usually don't have the slightest concept of the fundamental supply and demand factors that are supposed to affect the prices. So basically, now we are all retail traders, right? So I think the guys who are the floor traders are the guys who are in the exchange, who are near the exchange. I think there is something called high frequency trading. So these guys enter and exit in a fraction of a second. So they are, and especially the I think the the HNI, high net worth individuals, and the all those people, the big guys, what Shiva sir used to tell. I think they have the ability to move the prices, right? And they don't care about all your interest rate, balance sheet, weather pattern, and all these things, right? Furthermore, at any given moment, much of their trading activity is prompted by a response to emotional factor that are completely outside the parameters of the fundamental model. In other words, the people who trade and consequently move the prices don't always act in a rational manner. This is very important, right? So ultimately, the fundamental analysis could find that a prediction about where prices should be at some point in the future is correct. But in the meantime, price movement could be so volatile that it would be very difficult, if not impossible, to stay in a trade in order to realize the objective. Okay. So for that is why they tell if you are going for long term, you do fundamental analysis, and if you are doing short term trading, we cannot keep doing fundamental analysis because drawdowns might be very high, right? So far I think it's clear. If I'm going very fast, if I'm going very slow, just let me know. No sound. Am I audible? Yes, telling numbers. Yes. Fine. So I think it is clear so far. So we have completed one page. It's good. Fine. The next one. So far, the author is telling about the fundamental analysis. Okay, so this book is more about your psychology. This book is more about our brains, right? Our emotions, right? What make us decide. So this book is more about us. So you won't find much of all the techniques or trading systems or all those things. You won't find. It is more of for us to introspect. The author is telling from the fundamental analysis what has happened. Now this technical analysis has been around for as long as there have been organized markets in the form of exchanges. But the trading community did not accept technical analysis as a viable tool for making money until the late 1970s or early 1980s. Here is what the technical analysis knew what it took the mainstream market community generations to catch on to. Okay. A finite number of traders participate in the markets on any given day, week, or month. Many of these traders do the same kinds of things over and over in their attempt to make money. In other words, individuals develop behavior patterns, and a group of individuals interacting with one another on a consistent basis form collective behavior patterns. These behavior patterns are observable and quantifiable, and they repeat themselves with statistical reliability. So technical analysis is a method that organizes this collective behavior into identifiable patterns that can give a clear indication of when there is a greater probability of one thing happening over the another. In a sense, technical analysis allows you to get into the mind of the market to anticipate what is likely to happen next based on the kind of patterns the market generated at some previous moment. So far we saw about the fundamental analysis. Now they are shifting to technical analysis. So basically technical analysis, what it's, we all know, it is all these patterns, market price action, and how it different head and shoulder pattern, bull top, all these candlestick patterns, So basically at the end, all the patterns, what they are trying to tell, basically it is a fight between demand and supply, and we know what is going to happen. So too much, right? There is so much supply, and so the supply, because of that, the price goes down. There is a lot of demand, because of that, the price goes up. And there is a fight between these two. And at one particular point of time, somebody gives up and the market rallies, right? So this is the core concept of technical analysis. So because of all these patterns, the pattern is same, right? How much ever you keep on, time keeps on changing, there is only one pattern. What is the pattern? It's a fight between demand and supply, right? So because of that, it is very predictable, right? So as a method for projecting future price movement, technical analysis has turned out to be far superior to purely fundamental approach. It keeps the trader focused on what the market is doing now in relation to what it has done in the past, right? Instead of focusing on what the market should be doing based solely on what it is logical and reasonable as determined by a mathematical model. Okay, this is a huge sentence, right? So what they are telling is technical analysis, it is ignoring all the past data, right? It does not care, right? It's more like, guy might be taking first rank from his childhood till the 12th standard, but a guy might be in the backbench from the first standard to 12th standard, right? But after once he goes to college or somebody, the guy in the backbench might be the politician. The guy in the first bench will be the employee, right? So this is how, and he will be making more money. The guy in the first bench might not be making more money. So all these things, this is where the technical analysis is taking into picture. So as per the expectation, rational, poor guy who is taking first rank from the childhood till the 12th standard, he should be successful in life. But it need not be, or it could be also, right? But technical analysis ignores all those things. Basically, at this point of time, this guy has improved. This is going in this direction. So that is what it takes. That is the model it takes. It ignores the mathematical model of fundamental analysis. On the other hand, fundamental analysis creates what I call a reality gap, right? Between what should be and what is, right? It's more like, we have our own good versus bad kind of stuff. This is how it should be. This is how it should not be. This is how this should happen. If he is good, he should succeed. If he is bad, he should not succeed. Things like all these moralities, technical fundamental analysis has all these things, but what is the reality might be different, right? So that gap, that is what. Yeah.
Okay.
Reality gap makes it
No,
difficult
no prayer, no.
to make anything but okay. Guys, I think you can put your I don't know who is on the request all to mute yourself. Yes, thank you. Thanks a lot. Unless if you want to participate, I mean, it's not like you don't have to just ensure that you're contributing to this in a meaningful manner. Thank you. Fine. So this reality gap makes it extremely difficult to make anything but very long-term predictions that can be difficult to exploit, even if they are correct, right? So what is happening is, because of the reality gap, it makes it difficult to do predictions, right? Because it's so volatile and anything can happen, right? So, and it is very difficult to exploit also. So even if they may be correct also, right? So anything can happen. So because of the reality gap, because of the perception, this fundamental analysis takes a backseat. In contrast, technical analysis not only closes this reality gap, but also makes available to the trader a virtually unlimited number of possibilities to take advantage of. The technical approach opens up many more possibilities because it identifies how the same repeatable behavior patterns occur in every time frame, moment to moment, daily, weekly, yearly, and every time span in between. In other words, technical analysis turns the market into an endless stream of opportunities to enrich oneself. Okay, so I think it's clear so far. If you're having doubts, just let me know. Else, I'll move on to the next. Now, this is the important thing: the shift to mental analysis. Okay, so far we saw what is fundamental analysis. Basically, we have all these things called books and all the interest rates and all the balance sheets. But what happens? What is the main thing which the fundamental analysis ignores? It is the reality check, right? It ignores the emotions of the people who are participating, right? So that is taken care by the technical analysis. Technical analysis, what it does not care who you are. It does not care whether you are a good guy, bad guy. It does not care whether your promoter is good, bad. It does not care whether you're a pump or dump scheme. It does not care any of these things. It just asks you to stay. Okay. Just a minute. I think I might need to do a little bit. Yeah. Okay. If one we have to do a little bit amount of admin work, fine. The final thing, now we have seen fundamental analysis, technical analysis. Now is the shift to mental analysis. This is the core part of the book, right? If technical analysis works so well, why would more and more of the trading community shift their focus from technical analysis of the market to mental analysis of themselves, meaning their own individual trading psychology? To answer this question, you probably don't have to do anything more than ask yourself why you bought this book, right? The most likely reason is that you are dissatisfied with the difference between what you perceive as the unlimited potential to make money and what you end up with on the bottom line, right? So we have all studied all the technical analysis, all the indicators, all the systems and all these things. But in spite of that, we think that it is an endless stream of opportunities to enrich oneself. But what is happening? We take losses. We incur drawdowns. We don't know how to handle that, right? That is the problem with technical analysis, if you want to call it a problem. Once you learn to identify patterns and read the market, you find there are limitless opportunities to make money. But as I'm sure you already know, there is also a huge gap between what you understand about the markets and your ability to transform that knowledge into consistent profits or a steadily rising equity curve. So we all will face this, right? In one day we'll make huge money and then we lose that. We lose more than that also, right? And then again we try to understand, we go back to our basics and we try to, so this is what they are trying to tell. Think about the number of times you have looked at a price chart and said to yourself, it looks like the market is going up or down, as the case may be, and what you thought was going to happen actually happened. But you did nothing except watch the market move while you anguished over all the money you could have made, right? So there are times when we see the chart, it is going like this, okay, we're just going to break down. But we won't do anything because we are scared, right? Because anything can happen. We can tell that it will go down, but it will go up also. We can tell that it will go up, but it will go down. So this kind of, so as a result, what is happening? We have the flight or fright mode, but we go to the freeze mode, right? So because we don't do anything except we just watch the market move, and you'll be wondering why we could have made this money, right? But we did not make. So there is a big difference between predicting that something will happen in the market and thinking about all the money you could have made and the reality of actually getting into and out of trades, right? So we can predict, we can tell, we can analyze, we can tell, we can go back, we can do back testing and all these things. But unless we take that trade and get out of the trade at the right time, we won't be making money, right? So this difference and others like it is what we call as, he calls it as a psychological gap that can make trading one of the most difficult endeavors you could choose to undertake and certainly one of the most mysterious to master. Okay. So the big question is, can trading be mastered? Is it possible to experience trading with the same ease and simplicity implied when you are only watching the market and thinking about success, as opposed to actually having to put on and take off trades? Right? So this is the biggest question. We all attend the courses and all these things, but we keep questioning, can trading be mastered? Right? It's like, can we simply go and enter and exist, take money and come out of it? Not only is the answer an unequivocal yes. So what he's telling, it can be done. That is what the author is telling. But that is also exactly what this book is designed to give you. The insight and understanding you need about yourself and about the nature of trading. So the result is that actually doing it becomes as easy, simple, and stress-free as when you are just watching the market and thinking about doing it. So this is what this book is trying to tell. What they are trying to tell is, it's not very difficult. It can be done. It is easy. Your psychology can be altered. It can be mastered, right? And how we are going to do it, that is what we read. So this may seem like a tall order, and to some of you, it may even seem impossible, but it is not. There are people who have mastered the art of trading, who have closed the gap between the possibilities available and their bottom line performance. But as you might expect, these winners are relatively few in number compared with the number of traders who experience varying degrees of frustration, all the way to extreme exasperation, wondering why they cannot create the consistent success they so desperately desire. Okay, so this is why we always see that, every time we log in, we have this nice alert coming everywhere. 95% will lose, 5% will make money, but we all believe that we are in that 5%, right? So we'll see how to go into that 5%. In fact, the differences between these two groups of traders, the consistent winners and everyone else, are analogous to the differences between the earth and moon. Okay, so basically there are two types of traders. One is the consistent winner, right? Every time they keep making money, and the rest. So this is the 5%, and this is the 95%, right? So the difference between these two is equivalent to the differences between earth and moon, right? So how we have earth and moon, similarly we have the 95% and the 5%. Earth and moon are both celestial bodies that exist in the same solar system. Just like we all are in the same trading environment, earth and moon is also in the same celestial body. So they do have something in common, but they are as different in nature and characteristic as night and day. By the same token, anyone who puts on a trade can claim to be a trader. But when you compare the characteristics of the handful of consistent winners with the characteristics of most other traders, you will find they are also as different as night and day. If going to the moon represents consistent success as a trader, we can say that getting to the moon is possible. The journey is extremely difficult and only a handful of people have made it. From our perspective here on Earth, the moon is usually visible every night, and it seems so close that we could just reach out and touch it, right? Trading successfully feels the same way. On any given day, week, or month, the markets make available vast amounts of money to anyone who has the capacity to put on a trade. Since the markets are in constant motion, this money is also constantly flowing, which makes the possibilities for success greatly magnified and seemingly within your grasp. So the author is comparing how the 95% and 5% equal to the earth and moon. So we can see the moon, we know it is there. It seems as if we can just put our hands and grasp it, right? But what is happening? It is not so easy to go to the moon, right? Journey is difficult. You have to put a lot of rockets. You have to put a lot of fuel. You have to first qualify. So those things. So trading is similar to that. So, and on any given day, week, or month, the markets makes available vast amounts of money. So every time there is a lot of money available, which we can keep on, it keeps on flowing ups and downs and ups and downs. And it seems as if it is possibility of success is greatly magnified. and seemingly within your grasp, right? Now he builds on that particular word. I use the word seemingly to make an important distinction between the two groups of traders. For those who have learned how to be consistent or have broken through what I call the threshold of consistency, the money is not only within their grasp, they can virtually take it at will. I'm sure that some will find this statement shocking or difficult to believe, but it is true. There are some limitations, but for the most part, money flows into the accounts of these traders with such ease and effortlessness that it literally boggles most people's minds. So I'm pretty sure we would have seen a lot of people on YouTube and all these things there. Not the gurus or something, but there are some genuine people whom I have seen. You can go and look at the verified profile, verified by Sensible. They'll be consistently making, 1 lakh or 2 lakh daily. They'll be making. So, and I keep looking at it, this is what will come into my mind, this line. However, for the traders who have not evolved into this select group, the word seemingly means exactly what it implies. It seems as if the consistency or ultimate success they desire is at hand or within their grasp just before it slips away or evaporates before their eyes, time and time again. The only thing about trading that is consistent with this group is emotional pain. Yes, they certainly have moments of elation, but it is not an exaggeration to say that most of the time they are in a state of fear, anger, frustration, anxiety, disappointment, betrayal, and regret. Okay, so fear, anger, frustration, anxiety, disappointment, betrayal, and regret. It's very important. This is the emotions. Yes, perfectly summed up, right? Especially this part. So sometimes we'll make good money and we'll be in a constantly, moments of elation, right? And but what is exactly on overall what is happening? We are in a state of fear, anger, frustration, disappointment, anxiety, betrayal, and regret. So what separates these two groups of traders? Is it intelligence? Are the consistent winners just plain smarter than everyone else? Do they work harder? Are they better analysts? Or do they have access to better trading systems? Do they possess inherent personality characteristics that make it easier for them to deal with the intense pressures of trading? All of these possibilities sound quite plausible, except when you consider that most of the trading industry's failures are some of the society's brightest and most accomplished people. So what the author is telling is, from here, I'll just do a quick brief so that we are not, deviating, we're not forgetting the whole picture. He started with fundamental analysis, he went to technical analysis, and then finally came to mental analysis. And in this, he's telling that there is a huge gap between what we have knowledge wise and but what comes back in the papers, right? What comes back in the trading system, what comes back in our order book, right? So when he compares, he takes the comparison of Earth and Moon to the 95% and 5%, right? 5% who consistently keep making money, and the 95% who randomly makes money or consistently keeps losing money or gets out of the market. Now here coming to that, he also tells what are all the things which are separating these two. In fact, what he says is that, in fact, the 95% people who are losing are actually, they might be very smart people in other areas of life. Okay, so that is what he's telling. All of these possibilities might sound quite plausible. Plausible means probable, except when you consider that most of the trading industry's failures are some of the society's brightest and most accomplished people. The largest group of consistent losers is composed primarily of doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, and entrepreneurs. Okay, I think that is why Shiva sir is successful. He's not any of these things, I think. So he came from restaurant background. Anyways, furthermore, most of the industry's best market analysts are the worst traders imaginable. Okay, so intelligence and good market analysis can certainly contribute to success, but they are not the defining factors that separate the consistent winners from everyone else. Okay, so they basically what the author is telling is you might be smart, intelligent, but it doesn't matter. Okay, the market does not care about you. It could be one of the factor, but it is not the factor. It is not the defining factor. Okay. Well, if it is not intelligence or better analysis, then what would be? So basically, the author is telling that you could be the industry's what is it called, excellent market analyst, right? You can come on TV, you can come on news, you can tell that it will go up, you can tell that it will go down, but yeah, but you will not be you need not be successful, right? So if it is intelligence or better analysis, what could it be? Having worked with some of the best and some of the worst traders in the business. So this guy, Mark Douglas, he was actually a trader, and I think he had his own trading firm and something. He worked with some of the best and worst traders, and he has helped some of the worst become some of the best. I can state without a doubt that there are specific reasons why the best traders consistently outperform everyone else. If I had to distill all of the reasons down to one, I would simply state that the best traders think differently from the rest. Okay. They sound very cliched, right? So I know that does not sound very profound. He admits that also, but it does have profound implications if you consider what it means to think differently. To one degree or another, all of us think differently from everyone else. We all think different, right? We all have our own unique thought process. We may not always be mindful of this fact. It seems natural to assume that other people share our perceptions and interpretations of events. In fact, this assumption continues to seem valid until we find ourselves in a basic fundamental disagreement with someone about something we both experienced, right? So we all think that we all think the same way because we all have these perceptions. For example, I did not expect all of you would turn out today. So that kind of validates my interpretation, my perception. And you yourself might not have expected that someone from this group will create this kind of reading session. But here we're all here, right? But there might be sometimes where we will disagree also. I will have my own perception, you will have your perception. So that is what this is telling. Other than our physical features, the way we think is what makes us unique, probably even more unique than our physical features do. Okay, so this is more like Gyan, I think, more of a fundamental, more of philosophical. I think this whole book might be mostly of philosophy, mostly. So now he's coming back to the traders, right? So now he says here a philosophy. Basically, we all think different, but there are some overlaps in assumptions also, and there are some disagreements also, right? So this is the chaos which we all have. Like you might be thinking one thing, I will be thinking one thing, and it might overlap or it might diverge, right? So now let's get back to the traders. What is different about the way the best traders think as opposed to how those who are still struggling to think? While the markets can describe as an arena of endless opportunities, they simultaneously confront the individual with some of the most sustained adverse psychological conditions that you can expose yourself to. At some point, everyone who trades learns something about the markets that will indicate when opportunities exist. But learning how to identify an opportunity to buy or sell does not mean that you have learned to think like a trader. So we all can look at the charts, we can look back at the charts, and we can tell once it has happened, hey, here is an opportunity, right? It's very easy. We can tell this is because we know what is happening the next. But that is the learning which we do. That is the learning which we do as part of the technical analysis, right? That doesn't mean that if you can learn how to identify the opportunity, does not mean that you have learned to think like a trader, right? So I think the first session, Shiva sir said something about the psychology, right? Where so he had some 4 quadrants, 4 types of traders, right? So that is the psychology part, right? Whether to, for example, whether you should go in, go out, whether you should have less amount or more amount, these kind of rules which we have ourselves, right? So that is what the author is trying to tell, to think like a trader, right? So the defining characteristic that separates the consistent winners from everyone else is this: the winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all, confident in spite of the adverse conditions. As a result, they are no longer susceptible to the common fears and trading errors that plague everyone else. Everyone who trades ends up learning something about the markets. Very few people who trade ever learn the attitude that are absolutely essential to become a consistent winner, right? Just as people can learn to perfect the proper technique for swinging a golf club or a tennis racket, their consistency or lack of it will without a doubt come from their attitude. So for example, I can learn how to swing a golf club or a tennis racket. But every time I swing a golf club or every time I throw a service in the tennis racket, whether I am doing it properly or not, right? So that comes with the attitude, right? So yes, that is what he's telling in this particular paragraph. Traders who make it beyond the threshold of consistency usually experience a great deal of pain before they acquire the kind of attitude that allows them to function effectively in the market environment. So traders who make it beyond a threshold of consistency usually experience a gain. So basically, there is a threshold of consistency. Consistent means consistently you are doing the same thing again and again and again. Consistently, you are making money. Okay. And if you are not in this zone, you will experience a great deal of pain. Okay. So before they acquire the kind of attitude that allows them to functionally efficient. So basically, you have to go through this kind of emotional and financial pain. That is what the author is telling. And once you do it, only then you will develop this attitude to function effectively in the market environment. The rare exceptions are usually those who are born into successful trading families, who started their trading careers under the guidance of someone who understood the true nature of trading, and just as important, they knew how to teach it. Of course, there are some people who are, who become traders young, right? Shiva sir himself has done some interview about one person who made from 40,000 to 1 crore, right? In Pugarendi or something. So he did not even complete. He was in the college. He did not even complete the his degree, right? So those are all the exceptions. Those are all the outliers, right? Obviously, they might be having, we don't know. I mean, it might be true, it might not be true. But what the author is telling is there are exceptions who might, they will start. We all start from where our parents leave, right? So that is, so if your parents are very, successful and wealthy, obviously you will start from there, right? If you are from poor, if your parents are very poor, you'll need more time to understand, because our mindset or psychology and all these things will be coming from that particular background. So that is what this author is trying to tell here. So fine, why are emotional pain and financial disaster common among traders? The simple answer is that most of us were not fortunate enough to start our trading careers with the proper guidance. However, the reasons go much deeper than this. I have spent the last 17 years dissecting the psychological dynamics behind trading so that I could develop effective methods for teaching the principles of success. What I have discovered is that trading is chock full of paradoxes. It's basically a contradictory statement and contradictions in thinking that make it extremely difficult to learn how to be successful. In fact, if I had to choose one word that encapsulates the nature of trading, it would be paradox. According to the dictionary, a paradox is something that seems to have contradictory qualities, or that is contrary to common belief, or what generally makes sense to people, right? So the author is telling that, we encounter a lot of what is it called emotional pain and disaster because we don't have proper guidance. And but not only that, he's not only telling that, he went ahead and he has basically done some research and analysis. And what he's telling is that trading by itself is completely full of absurd things. Absurd things means paradox. So you can tell it can go up, but it will not go up. And you can tell it will go down, but it will go up. If you tell it will go up, it will go down. Like things like that will happen. You might be thinking it should break down. Sometimes it will do a whipsaw. Sometimes it will just kick you out. It will touch your stop loss and then go back in the direction where you are supposed to take, right? So these kind of things happen, right? The absurd things. So that is what, and if you we don't understand this particular aspect. Financial and emotional disaster are common among traders because many of the perspectives and attitudes and principles that would otherwise make perfect sense and work quite well in our daily lives have the opposite effect in the trading environment. They just don't work. Not knowing this, most traders start their careers with a fundamental lack of understanding of what it means to be a trader, the skills that are involved, and the depth to which those skills need to be developed. So this actually perfectly summarizes my personal experience. It took me a lot of time to understand what is shorting, right? I could not sell first and buy later. I could not even make sense because I come from that particular mindset, right? I could not, because you need to have something to sell, right? But you don't have something to sell, but you sell it and then buy it back, right? It goes completely it was very difficult for me to understand. But that is what the author is trying to tell, right? The perspective and attitude and the principle. It would make perfect sense in the daily life, will have the opposite effect in the trading environment. They just don't work. So here is a prime example of what I'm talking about. Trading is inherently risky. To my knowledge, no trade has a guaranteed outcome. Therefore, the possibility of being wrong and losing money is always present. So when you put on a trade, can you consider yourself a risk taker? Even though this may sound like a trick question, it is actually not. So every time we trade, I think we all know that, we can, there is the fear which is there in our mind, right? Every time, what will happen if it does not go? What will happen if it does not go in our direction? How much can we tolerate? How much can we do the averaging and all these things, right? So now, are we a risk taker? That is what author is telling. So even though we might think that we are all risk takers, the author is telling it is not as easy as we are to answer that particular question. The logical answer to this question is yes. Basically, I engage in an activity, I know it is risky, then I must be a risk taker. That is what the author is telling you, right? This is a perfectly reasonable assumption for any trader to make. In fact, not only do virtually all traders make this assumption, but most traders take pride in thinking of themselves as risk takers. The problem is that this assumption couldn't be further from the truth. Of course, any trader is taking a risk when you put on a trade, but that does not mean that you are correspondingly accepting the risk. It's very important. We are risk takers, but it is very difficult for us to accept loss, right? After a loss happens, I personally, I don't know about this, but I do many times I've done a lot of revenge trading. I did not even know that about the word called revenge trading. Only after I did a lot of revenge trading, I read about what is revenge trading. Even now I am scared about revenge trading, right? So, so that is what. So I can tell that I'm a risk taker. We can all tell we can risk takers, but once a drawdown happens, it's like, atheist will be plane crashes, right? So it's like that, right? You can tell all the things, but once you get a loss, how you accept that? That is what the author is trying to tell. In other words, all trades are risky because the outcomes are probable, not guaranteed. Because every trade is a probability, right? Nothing is guaranteed. But do most traders really believe that they are taking a risk when they put on a trade? Have they really accepted that the trade has a non-guaranteed probable outcome? Furthermore, have they fully accepted the possible consequences? Right. So whenever we make a trade, do we really accept that this is probability and not a guarantee? No. And if it is going to go against our directions, are we ready to accept the consequences? No, right? So most traders have absolutely no concept of what it means to be a risk taker. In a way, a successful trader thinks about a risk. The best traders not only take the risk, they have also learned to accept and embrace that risk. Okay, there is a huge psychological gap between assuming you are a risk taker because you put on trades and fully accepting the risks inherent in each trade. When you fully accept the risk, it will have profound implications on your bottom line performance. So what is meant by risk taker so far? The author is telling that you can, just because you are participating does not mean that, does not make you a risk taker. You will become a risk taker only when you accept the drawdowns or when you accept the losses, right? So the best traders can put on a trade without the slightest bit of hesitations or conflict, and just as freely and without hesitation or conflict admit it is not working. They can also get out of the trade even with a loss, and doing so does not resonate the slightest bit of emotional discomfort, right? For me, this is something which I am trying to learn, right? And in other words, the risks inherent in trading do not cause the best traders to lose their discipline, focus, or sense of confidence. If you are unable to trade without the slightest bit of emotional discomfort, specifically fear, then you have not learned how to accept the risks inherent in trading. This is a big problem because to whatever degree you have not accepted the risk is the same degree to which you will avoid the risk. So trying to avoid something that is unavoidable will have disastrous effects on your ability to trade successfully. Okay. So unless we accept that the today I'm going to make so much loss, today I am okay to, this is the amount of money which I will lose. And once it happens, it is part and parcel and I move on. Until we accept that, we will not be able to do well because we will be fearing, right? We will be fearing what if we lose, what if we lose. But once we accept that we'll lose, it's like, the fear will not be there, right? It is because it's no longer unknown, it's a known thing, right? And if you try to avoid that particular unknown thing, we will ultimately end up going there only. That is what he's trying to tell, right? Trying to avoid something that is unavoidable will have disastrous effects on your ability to trade successfully, right? So learning to truly accept the risks in any endeavor can be difficult, but it is extremely difficult for traders, especially considering what it's at stake. What are we generally most afraid of besides dying or public speaking? Certainly losing money and being wrong. Okay. So we don't want to lose money and we don't want to be wrong. They both rank close to the top of the list. Admitting we are wrong and losing money to boot can be extremely painful and certainly something to avoid. Yet as traders, we are confronted with these two possibilities virtually every moment we are in a trade, right? So the author is so far has said from the mental analysis, it's more, it's going in a zigzaggy, flowy version, but I think it will all catch up. So we all saw what is fundamental analysis so far and why it was not working, and we saw why everybody moved to shifted to technical analysis because of the reality gap, and finally, even if that was working so well, we are all failing because that was the need, because we all know when to enter and exit, but we won't do it because of the psychology which we have, because of the problems which we have inside our mind. And for that, author is telling, can it be done? It's more like he's comparing the difference between 95% and the 5% with the earth and the moon, right? And finally, he also tells that, the people who are in the 95%, They are consistently, they have something called discipline, which they keep on. It's more like, whenever they want, they can come and take the money whenever they want, right? That is what the 95% are doing. But what happens for the rest of the 95%? We usually will have some amounts of elation. Someday we'll have success, but then we'll have all these kind of emotions, right? And it is not just if you are intelligent does not mean that you will be successful, and it has more than something to do with intelligence. Although intelligence can help, but what matters is how you think. And now again he comes here and tells that instead of we all have some different unique thought process. Some may overlap, some may not, right? That is what he says in this paragraph. And then the traders who are how they are thinking, basically they have while indicate that how, and it does not mean that just because you know how to identify, if you are expert technical analysis does not mean that you are a successful trader, right? And finally, usually you go through lots of ups and downs to and finally reach that particular threshold. Rare exceptions, outliers are the people who are already, they have parents or who are people, families who are in that successful. They get all these particular training, right? Guidance. But not only the guidance is needed. Again, you have to understand that it is full of paradox, right? Market is completely full of paradox, and it is inherently risk. And then he comes to the concept of risk, right? He said all these things. He said like, this, that, but finally he comes down to what? He comes down to risk. And he's telling whether are you really, he's basically trying to break our ego, right? So that you become Zen mode. That is what the author is trying to tell. The author is trying to tell that, you can pompously tell that, you're a trader, you're a staker and all, but once you get the loss, you will not be. How you react, how you respond to that is what matters. And finally, he tells why you behave that way, because we are scared, right? Because we are scared. That is what author is trying to tell. As you see, every paragraph is ultimately going down, and it is going down to the psychology, basically, or fear, flight, fight, and freeze, all those fundamental basic animal instincts, right? So losing money and being wrong, you don't want that. You don't want to lose money, you don't want to be wrong, you don't always be right, you want to make a lot of money. But every time we make a trade, these two are there, right? We'll be wrong, and if we are wrong, we'll lose money. If you're losing money, you're wrong, right? So how do we remain disciplined and confident in this phase of constant uncertainty? When you have learned how to think like a trader, that is exactly what you will be able to do. Learning how to redefine your trading activities in a way that allows you to completely accept the risk is the key thinking to successful trader. So this is where the author is finally huge. We are running out of time. We'll try to continue tomorrow then if it's not. So I think we'll put a pause here and we can have a small discussion and then we can wind up. So this risk is what makes the successful traders. Once you understand that, there is a risk involved. Once you understand that, there is you have to accept that. That is when you will become a successful trader. So yeah, I think we'll put a pause here because we're already 7:57. So you guys can, if you want to, discuss, you can tell your opinions, you can want to share, you can. So how was the session today? I think it was good. I don't know. Was it good? Okay, everybody is on mute. Let me see the chat. Okay, fine. Oh, super. Oh, I didn't see the chat. Online class. Okay. Don't call me Sarah. No, I am just like you guys. I mean, I'm not. I'm also starting like you. I wanted to read all these books. I started reading, but every time I read 1-2 chapters and then I I get distracted and all these things. I thought if we make this as a collective initiative, you all can read, you all can. I'll share the recorded video in YouTube, and because some people were asking, they will not be able to join also. But see, more from it's not a question of sharing the YouTube, but I would. This is more like yes, I'll share. More like, unless we have this discipline, this whole session is mainly to get that discipline, right? It's more like, putting ourselves now it's, you see, I cannot escape this. I have to read this because you guys are there. Similarly, you cannot escape this because this session is going to happen. This entire book is already available in the YouTube also. It is not very difficult, but let us try to come online. I'll definitely share. I understand there will be some outlier exceptional cases also, but we'll all try to, make it, try to join 1 hour a day, right? We'll try to read this book. And there is one more book called Disciplined Trader. That also it's in my list. There are many books actually. You can keep reading. There's no end for this. Fine. I think we'll pause here. We will continue tomorrow. Same time, fine?
Hi, Bharat. Can you
Yeah.
hear me?
Yes, please.
Hi, Bharat. This is good. Good initiative, actually. I just wanted to, can we discuss like 5-10 minutes about the market, how what went wrong in the market today, like Sir discusses now. It will be also good for us talking about the VIX. What about today's market? Like 5 minutes, we can have a brief of today's market like that.
Sure. We can.
Because I am also a newbie, and when Sir was telling, it was like commentary, and it was okay. I understood everything. But now when I see it, it's a bit of confusion. And yes, definitely fear is there.
Yes, you are right. Actually, see, I am also not very expert and all. I've been here for a couple of months. I have my own set of losses and all these things. So
Yeah.
maybe you can share whatever I know. If you can share, you can share your screen also. I mean, it's not like I have the control.
Anyone means not only you, anyone who
Yeah.
has expertise a little about what went wrong. This was acting like that.
Yeah. So maybe I'll share what happened today in my trade.
Yeah.
Today I made a profit. I made that doesn't mean that I have made a lot of losses. I made huge losses. Okay. So, but I could afford a little bit at this point of time. I could afford the losses. I entered the market by loss actually. That is my history. I invested. I did not come into options and all. I bought some shares of some company without doing any analysis. Yeah, you can stop the recording. I think you can record. It's okay. People who want to, it is more like, impromptu. They can also see what discussions we are doing. So I lost a lot of money, and by blindly, just going, and because I knew that company and it was my known company. And then the minute I entered, it started going down. Whatever Shiva sir said, exact thing happened. Okay. So it's like, as if he came inside my brain and read whatever happened and then said it as his own story. Something
I think it is every trader's journey he has mentioned.
Yeah, actually, I was not a trader. Actually, at that time, I was like, simply. I made some 7 years before. I invested some 2 lakhs in Reliance, and it became 3 lakhs. Okay, so at that time, I was like, it was like free money, right? I mean, and then the same concept I applied. It gave me a nice lesson, right? So this time I invest a huge amount, and then it comes down. It becomes half of whatever. Poof, it vanished out of thin air. So that is how I came, and then I took some. Then I made some money in that Adani fiasco by shorting. I did not know what I was doing. Also, I shorted. I sold. I did not know. Then only after doing only I got to know. It was by mistake. I pressed the sell button, I think, and it Zerodha accepted it also, and then. I made some money, but then I started learning, this shorting is fantastic and all. And then I lost huge money also. So that is how I entered, and I made huge losses. But the more and more I heard more and more about the losses, the more and more I started becoming serious, and that is how. So I am. So today I made some profit. So first one which today I made was in the opening trade. So in the opening trade, and I do only Bank Nifty nowadays. I don't do anything else. So the opening trade, what happened was I had some notes. Maybe I can share the notes. Let me take the camera. I don't know.
So from 3 days, Bank Nifty is like making a formation of dozy only.
Yeah. So just a minute. I'll just in my notes is visible or not. Let me stop. Okay, I think it's not visible. I think it is. No, I think the camera is not so great. It's fine. Fine. I'll just share the screen. So what exactly basically in the morning I did was I went to investing.com as Shiva sir has said. I have my portfolio. I made a note of all the things, Dow Jones and all these things. I wrote it down actually. I wrote everything down, and I thought that and I also saw that in the news in the morning it was telling that Asian markets were little bit it was going up because the what is it called, FedEx, basically they did not increase the rate, right? Basically they did not increase the repo rate, and so as a result the market is thinking that Fed is done with the repo rate, so everybody is now becoming bullish, right? So I think most of you know about the Fed and the repo rate and impact, right?
Yeah.
So basically, if the interest rates are not going to increase, it is like we are no longer be cash crunched. So obviously there is a room for growth. So I then what happened? There is another thing. I think. So basically, it was coming somewhere here. There is a Camarilla R3 was there. It started from there. I think it's not coming here. We put. Yeah. So I think it started off. See, as you see, it started off somewhere in the. Let me see. It started somewhere of the resistance. I think it started somewhere, and then I realized that the direction will be positive. Okay, so it started off with a huge gap up. Also, Nifty started with a huge gap up, and so what happened was, so my goal was it will go up, right? So the yesterday it was actually there is one more thing which I do is CPR. CPR. Yeah. So it was actually I don't have the exact indicator. I need to log into my because I don't use TradingView. I use TV.them, but I need to get the just a minute. Yeah, it's coming. So as you see, today it is more like let me go. Yeah. So this is actually a virgin CPR. So basically, this is a CPR, and the entire day it did not even touch any of these things. So this is a virgin CPR, and so as you see, it started above the R3, right? And by the time I entered the trade, it actually broke the. This is the Fibonacci R3. This is a Camarilla R3. This is a Fibonacci R3. So at this point, I entered a trade, but actually it went and bounced from here. So I entered a trade here, and I knew this is the zone of supply. So I started here exactly when it went here, I exited. Okay, so this is one trade which I made today, and the next trade which I did today was at this particular candle. So as you see, I had drawn this particular line. So this is where I could have entered. I wanted to enter here actually. I had actually in the trading view, I had drawn this particular line, and it broke here. But by the time I entered here, I was about to enter here, it went here. Okay.
So you were
So-
short, you are selling or you are buying only?
Yeah, I wanted to be, I want to go on a negative shorting basically.
Shorting, okay.
So here I made CE trade, but here I wanted to make a PE trade, but by the time I could enter it, it was so swift actually. So I got scared. I mean this, like, this is a mother candle, right? This is like huge candle. It's very difficult to capture. So I was waiting. Then I knew it will come down. I expected it to come down to R3. This is the Camarilla R3. So I took a trade here, but what exactly happened was I made some 12,000 profits or something. And in this particular thing, it went down and then came back. I panicked and exited again. Okay, so I made some 1,000 loss. Basically,
So
for
how many lots you traded?
I think 60 lots, 900 quantities.
Oh, okay.
So and once this game became a red candle, the trending OI also was red. So I took another trade again. I did the same thing. Basically, I exited here with a loss of 1,000 rupees, and I did the same thing again, and it went till the ground. By this exactly at this particular location, I exited. So here also I made some 20 to 25 points profit today, and here I made some 15 points. So then after this, I quit the trading thing. I did not want to, I wanted to enjoy it basically.
Yeah, true.
I didn't want to, I have this urge, so I kill switched everything. I have this account, I have the Zerodha account also, both things I kill switched. So that is what happened today. But obviously here, but many were telling sideways day today. I don't know, but here it seems like from here it goes up and up and up. But I kind of exited, stopped looking at the market. I have my other work. I started going there. So
Great.
that's what happened today. So you can, anybody else, if you want to share, you can share your screen and tell. Okay. Fine. Anything else? This is one thing which, so usually this is what I'm doing nowadays. Sorry,
Okay.
let me
So
share again.
why you picked only Bank Nifty?
Because Bank Nifty has a good volatility,
That's right.
and I don't know why. I kind of wanted to, stick with one particular thing. Earlier I used to be in Nifty, okay. But after Nifty was so slow, and at that time Nifty means I was not even, when I'd say earlier, I had zero knowledge of any particular thing. I went into some what is it called, Telegram group. They will tell this will go this way, that will go that way. By the time he tells, and by the time I take the trade, it will be, he would have made the profits, I will be in loss. So at that time, so then that is when I started to, going to watch YouTube videos and all these things. I saw Shiva sir's thing. I also keep seeing Ammu Mahadevan's.
Yeah, I got introduction of Shiva sir through Ammu Mahadevan's video only.
Yes, me also the same.
Oh, see.
Today,
He also launched some mentoring program. Did you?
yeah, I joined that also. That is how I learned all this.
How is it?
It's good actually. It's very good.
Okay, I was thinking of.
Yeah, I think now it is over, but the recorded videos are there.
Recorded are there.
It all this her
Yeah,
setup is
that's what I was seeing all your setup and I was thinking of Ammu Mahadevan also uses this setup only.
yeah, same. It is
Correct.
it is makes my life little bit easier.
Yeah, true.
I just draw these lines, and obviously, not only that, I also connect this with OI Pulse also. So when I was taking this trade about here, trending OI was actually in the green.
Mm.
It was very good. It was some around 20 lakhs or 30 lakhs or something.
Okay.
And I took it and I exited. And one thing which I learned from Amu is that you don't have to, if you can make 20 points or 25 points, it's good. So don't be greedy, because many times what happens is I would have made the point and it will come here,
Correct.
and I'll do some averaging out, but it will go here, right? So so this kind of things were actually Shiva sir's risk is something like that.
Yeah, correct.
But Amu's risk is not like that. So Shiva sir will do averaging till here also.
True.
He'll average, and then finally he'll make money here, right?
And
So-
when we see him, it's like so much smoother. Hey, it's very easy. It feels like.
Yeah. So that is the one thing which I learned from Amu. Her course is actually she did a wonderful job.
Okay, then.
She's even now she's being very genuine.
Oh, yeah, she is genuine. That's there. Okay.
So that is how today's trade I've actually followed whatever she had taught. So this Fibonacci R3 and all this Camel R3 was actually from her.
Great. Thanks, Bharat. Thanks.
Sure. So this is what I do daily. I kind of make note of this thing. I take an opening trade, and then for some time I see, because what is happening nowadays, a lot of sideways is happening.
Yeah, correct.
So here and all, if you enter, will definitely lose on the time decay.
So you take after the first and second candle, or how?
Yeah. So I try to complete before 10 o'clock. So mostly by 9:30, my first trade, I am seeing profits.
Great.
So I'll wait for the first candle,
Hmm.
and then I will see what the second candle. I will go for maybe 1 minute time frame, and
Yeah.
see, for example, this went at a huge thing, right?
Correct.
So then I was a little bit skeptical, because already market has traveled so far, right? It has got so much rejection. So we don't know whether it will go from here to here, or because then if it had shown sign of breaking this particular R3, then I will take a reversal. So she has taught a lot of things actually. When you
Okay, great.
if you see that course, there are multiple things she will teach about elder impulse, all these things, and then we can go from here to here.
Okay.
So this particular opening trade was by her. This trade is also by her, because I was waiting it to go till here. But the minute I saw here and made my profits, I exited. But luckily, it went from here to
Up on.
opposite direction.
Great.
So yes, that's all. So anything else you guys want to share? Yeah, I'm sharing. Or else we will wind up today, and then we'll continue the next session of this particular book tomorrow. Okay.
Yeah. Thanks, Bharat.
Thank you, ma'am. Thanks a lot. Thank you, guys. Thanks you for joining. We'll see you tomorrow. Okay. Bye.